Joining us to talk about some opportunities in the fixed income market is Mike Cudzil. He is Senior Bond Portfolio Manager at PIMCO. And Mike, first of all, the volatility is something that you think is here to stay when it comes to the bond market.
Yeah, for sure. I mean, thanks for having me. Good morning. Volatility is something that, without question, is going to be here for the foreseeable future. The administration, with their tariffs on, tariffs off, policies on, policies off, the fact that this is policy by executive order just makes it a very uncertain environment, makes markets very volatile, and means that, for the foreseeable future, volatility is here to stay. The good news is that even though it's volatility in the bond market, it's volatility in a very narrow range. So, we've been in a 75 basis point range, less plus, for the better part of 18 months. And fixed income is looking quite attractive relative to the rest of, the kind of risky asset and financial landscape.
Why do you think that? You think we're headed for rough times economically?
There's certainly the potential for rough times economically. We've, downgraded growth pretty meaningfully since the beginning of the year. We think came into the year at a pretty strong economic backdrop, although a slowing environment. We've taken growth down from 1.75% to basically zero, putting a recession at a coin flip, and taking inflation up from 2.5 to 3 to 4 to 4.5. Obviously, all this is very uncertain. I haven't checked True Social in a couple minutes, so unclear as to exactly what the forecast will be in the next 6 to 12 months. But directionally, slowing economy with higher inflation definitely injects more uncertainty into the picture.
We've been talking about this morning whether the USA brand has been damaged or not, whether this is something American consumers maybe look to buy more American. What are your thoughts?
Okay, so first, is the USA brand damaged? I would say definitely not. However, the mere fact you're asking the question is a bit concerning. I think, in times past, if you have volatility in the market, you have drawdown in equities, drawdown in fixed income, dollar cheapening, that would generally tend to lead you to believe there's some unwind and risk, not is the brand damaged. And so I think it's an open question. It's something we're certainly entertaining and watching. We don't think so. We just sold $180 billion in treasuries this week, all traded fairly well. And to your point, yields are lower than they were kind of pre-liberation day. So as of now, we don't think so, but it's a concern and something we're paying attention to.
How do you factor the Fed into what's happening here and whether they're going to raise or whether they're going to cut rates? Because the market's certainly been anticipating that some rate cuts could come. Yeah,
Freudian slip on the raise rates there.
Yeah.
I mean, what's the Fed going to do is very, very open question. Obviously, with 4.5% inflation. But having said that, the Fed told us in their playbook from 2018-19 that the tariffs are ultimately a tax. They're supposed to look through tariffs and they're supposed to respond to the growth drag that ultimately comes with them. It's a little bit different this time around. We're coming from higher levels of inflation. Inflation expectations have risen pretty precipitously, and that's certainly catching the Fed's attention. But ultimately, if the data does turn, we think the Fed will cut and potentially cut very meaningfully if they need to, regardless of where inflation is at the time, because ultimately if you're in a recession or growth is slowing meaningfully, it should ultimately lead to lower prices. So, yeah, we do think the Fed will respond. We do think they'll cut rates if they need to.
Is ultimately in 2 weeks when the FOMC meets next?
No, absolutely not. The Fed won't go in May. They're going to need to see it in the data. And even the data, in June most likely doesn't give them the room to cut just yet. So it's not something that's imminent. It's something that's possible, and it's something that's possible. They cut more if needed. Again, if the economy holds up well, if tariff policy is more negotiation than it is ideology, then it's potential that the Fed stays on hold a bit longer.
Okay, but Mike, does that mean that there's a floor on this market? I mean, is that a put effectively? Is that the Powell put, or is it the Bessent put, or is it? And what does that floor look like to you?
Yeah, so Is there a put? I think the Fed's reaction function is one that they will focus on the economy. And so if you determine that as a put, there is a put if the data turns extremely negative and we have, negative jobs, the Fed will absolutely cut rates. The second way the Fed can, theoretically, quote unquote, enact the put is if, the bond market's reacting in ways that are not consistent with economic activity, and you have the speed at which rates are rising, that the Fed potentially engages the balance sheet. We think that's a little bit premature, but certainly something that the Fed could do if rates were to rise precipitously relative to economic activity. So if you had a slowdown with rates, up a very meaningful amount, the Fed could engage in some sort of liquidity management exercise to make sure that everything is functioning as needed. In terms of Bessent, it's again. The administration is very focused on yields. It's quite possible, they hold auction sizes consistent for longer. It's potential they shift auction sizes in a little bit on the curve. But ultimately, yields are going to be a function of growth. And if you look over long periods of time, yields are consistent with the levels of nominal growth. And we should, really care about growth, and wherever yields are will be where yields are.